Mr. Turkington, how are you?
I'm good. How are you?
I'm doing well. 15 years, dude. What the heck?
What's that comedian referenced it when he was talking to his wife about being married for 20 years. He said, "Man, feels like it's only been 20 minutes underwater." So the last few months has been somewhat similar, but good Lord, 15 years has flown by. And what an interesting time frame or series of events can be capsulated in 15 years.
Yeah, I'm thinking of the 10 years we worked together prior to the 15 years. We were just doing a little bit of reminiscing on that. We'll try to keep this somewhat entertaining for you guys that are going to watch this.
Fingers crossed.
Yeah, but I mean, a 25-year run together, fist bump, well done.
We survived.
We made it. We've gotten into our 50s, so we've done something right. Um, but really, that great financial crisis, or whatever you want to call that, 2007 to 2009 range, that's what moved us from our other company that we were previously working for, who decided to get out of the business. And then that's when you and I looked at each other and said, what the heck, let's give it a shot and let's go into the mortgage broker space. And we weren't a mortgage broker before that. We were working at an independent mortgage bank, totally different animal. And there was a lot of uncertainty at that time in 2007 when we started off. You want to chime in here? And
Yeah, the decision, if I remember correctly, it's been a minute, so refresh my memory, but I feel like that the decision we made at that time to get into the mortgage broker space was easy. And it was easy for one reason. There was so much chaos going on in the mortgage landscape, with companies understanding the crisis that was going on, real similar to what we're seeing right now, where there is a contraction in loan volume, and we didn't feel like we had confidence in any other company in the management to go sort of hitch our wagon to them, because the management decisions, business cycles, we were fearful that we might have to change companies, maybe multiple times. And we said, hey, let's just get back to dealing with the customers. We'll put a shingle on the wall that says where we're at, and we'll go find the banks behind the scenes to serve that need, so we didn't have to keep bouncing around. So does that sound similar to what you recall at the time?
Absolutely. Yeah, I think we thought we were too experienced to go work for someone else. But we were ready to take on this mission by ourselves, and we've got this. And we were excited about it at the time of, let's get into the self-employment world and run our own business. We've been there and done that, so we felt we were ready. Now, the broker space at that time hadn't yet been hammered with regulations, so that took a few more years after we got started, where really all the pressure came down on the mortgage brokers. They were the ones that caused the great financial crisis. That's what the media was portraying at that time. And after a couple of years in, you and I were looking at each other going, do we have to move again?
It was sketchy, I guess you could say. And I remember a lot of the folks that we had worked with in the past had immense anxiety that the broker channel was just going to be dismantled entirely. And
Vaporized.
yeah, there were some challenges along the way, but it was more just the loans and the industry, sort of the landscape of the business. It wasn't the broker channel. And then, man, shortly after we got through that, the broker space has picked up momentum ever since then, and now is as abundant or more abundant than I think you and I have ever seen since we started back in 96 or 97. So
yeah, the thing that we feel about being a broker is control And the thing that everybody else talks about as the negative of being a broker is you have no control. That's a little difficult or confusing to think of, but when you had talked about lining up different banks or lending institutions behind the scenes where we get to create and establish relationships with those folks, and they know who we are and what our track record has been to get us to this spot, we felt that that gave us great control, or enough control, combined with the lowest rate and fee available to the consumer. That's why we've remained in this spot.
Yeah,
Is-
the ability to understand call it the structure of a loan, we had good confidence in that, right? Meaning that, hey, I understand what the quirks of a borrower and getting them qualified, and I have no problem going in and sort of communicating with an underwriter to figure out where the gap is and get it across the finish line.
Yep.
So that the only thing that we struggled with was understanding how long that time frame was from the time a challenge was identified to being able to get it solved. And in our world, we said we can navigate that 2 or 4 days, and it makes more sense to do that and get a better deal for the consumer than to go work for a bigger company where I can walk down the hallway, get an answer in a call it an afternoon, but yet have the consumer pay an eighth to a quarter more in rate, or $1,000 to $1,600 more in fees. So that balance has bless you, always added up to us, where if we do our job right and get at the details quick enough, we can still get that time frame from start of loan to closing is faster than anybody in the industry. So that was kind of why the broker space never was real intimidating.
Yeah, we have the best of both worlds, because if we don't like lender A, we got lender B. If we don't like lender B, we got lender C. But no matter what we have, it is the lowest rate and fee combination to the consumer. Now, with that being said, there might be some ancillary products that we don't have, or niche areas such as a home equity line of credit. We can do them. We choose not to because they're not competitive coming through us.
Now
A
the process is
construction
more
loan.
complicated, and it's more expensive than if you go to the direct source in today's environment. Well said.
Yep. Construction loans, never got into those. Again, our idea or our vision was, let's do what we do well, do it better than anybody else. And if we can't do it, let's get them to somebody who does it well and better than anybody else. And that's worked out for you and I for 25 plus years. We've had to move one time. Before you put that timeline back up, right now, late 22 feels like late 2007, doesn't it?
It does.
So bizarre.
Almost identical.
So the reason I bring that up is you're going to put up a timeline of what you and I have seen over the last 15 years. And I think we're close to full circle. So let's throw that up there and see what we got.
Can you see that okay?
Perfect.
Yeah. So what caused, the company that we had worked at for 10 or 11 years together, what caused that company to decide to shut its doors? It was massive expansion and constant growth leading up to that. And then there was the contraction in loan volume, along with the subprime meltdown, or the stated income, stated asset liar loans. Those got yanked out. So there were just not enough transactions for the amount of players in the industry. Super similar to what we're seeing right now.
Yeah, bizarre. Again, we talk about the quality of the loans that have been done over the last, since that time, much stronger than those loans that were being done back then. So
yeah,
this is why
we could go on for 2 hours about some of the crazy stories of the loans that that we heard stories of, not that we participated in, but we heard stories of in the industry that caused some chaos. And then, yeah, you said right there, we started, we got our mortgage license, I think it was March of '08. And as soon as we got that, we benefited from some lower rates initially. And it was shortly thereafter that, short sales became the rage, and meaning that property values had dropped, foreclosures were skyrocketing, and that was when the fear that the broker channel was going to go away.
Insane. So all the property values were dropping back then. And now here we are 15 years later, where all the property values have exploded over the last 24 months.
So that 2008 to
wow.
2011, the PMI, or the mortgage insurance on FHA loans, those were constantly fluctuating. Lenders didn't even issue PMI, or PMI companies wouldn't provide PMI for a period of time because it was too risky. Nobody could figure out what values were doing because they were declining. Yeah, it was chaos compared to now, where PMI rates are almost free in comparison to those numbers back in the 2010 to call it 2014 period of time. A fraction.
So why did everybody have to refi in 11 through 13? What was the reason behind all of that?
So, there was an incentive or a push to keep homeowners in their home and not want to say my home's down in value and flee. So there was an incentive that people could refi even if they did not have traditional equity in their home like we've seen before. Not only that, but the equity markets were in chaos, so we were blessed with lower mortgage rates. So it was attractive for people to go from rates in the, we'll call it mid fives, down to something that would be, under 4 or in the mid 3s, to save money and entice people to stay in their home. So there was just a ton of activity that was associated. We were really, really busy at that time.
Yeah, they wanted to subsidize a lower housing payment, basically.
Yep.
Is what they were allowing them to do. We're going to throw all the old rules out for right now. Right now, we don't care what your home is worth. We want you to have the lower rate. We want your household budget to be able to get solvent so you don't walk away from the house. Okay. Cash out refis were abundant 14 through 16. What was that about?
Well, at the end of 2012 and into early 13, that's when the bottom, it had been formally admitted by the world that the crash or the bottom in real estate values had been hit and was in the rearview mirror. So property values had started to go up with increased certainty that people were buying and wanting to take advantage of home ownership again, where a lot of people had just said, forget this, I'm going to rent. We'll call it from 09 to 13. So as more people buy, the demand to purchase increases because of good rates and affordability, property values went up. So some of the folks that hadn't been able to do anything since, we'll call it 07 or 08, with regard to accessing some equity to either consolidate debt or to finally be able to put money back into the home and improve it, freshen it up, that was a big chunk of the activity that we experienced at that time. Again, if you fast forward to now, we've been blessed with increased equity or home values. In using a traditional mortgage right now doesn't make sense due to the rates, but using the equity to consolidate or improve the property absolutely makes sense.
So in that 14 to 16, now 17 to 19, the economy was humming along. The one thing we didn't put on here is the Fed purchasing mortgage-backed securities to keep overall interest rates low.
And that was certainly the case in that HARP refi day. So that 2011, yep. Yes, that's when what was it called? Quantitative easing, where they.
Yep. So when I see here 2017 new construction comes back, I mean, really, new construction was off the table for about 8 to 10 years, where it wasn't, it was irrelevant, basically. And now, if we fast forward over the last 5 years and including now, oh, it's a big part of the housing market for sure. Maybe as big as it's ever been. And
It certainly could be.
well,
Yeah, right.
it can't be when
Should
interest
be.
rates are above 7%, which we know in October and November, that's what we've been battling. Now we roll into December and we're getting back into the sixes, low sixes as of yesterday. The quantitative easing has left the building, and they've been tightening and tightening and tightening, trying to slow demand of you. The one thing I see on there, excessive second home and investment buyers. All of a sudden, because of the pandemic and the work from home technology that most companies have right now, it was a game changer. It just
Yeah, it
changed the game.
opened up a perspective to so many people that normally wouldn't be able to entertain that, whether it's relocate fully or consider a second home. Yeah, the Airbnb craze of, hey, I can occupy it for some time and I can rent it out, making that process easier than it's ever been. Opportunities for folks, just, I mean, it just made it super interesting for people to gravitate toward real estate. And it's a
When
tangible investment.
I relocated in 2017, and it was hard at that time. We had the ability to do it from virtually, but it was still difficult. And then by the time April or May of 20, when everybody started doing it, and then it became the norm by the end of 20. And
It
then,
was a cultural change for us in 17 when we said, we don't want to meet people in our office anymore. And I remember that, in some conversations, and it's like, hey, does it make sense to coordinate 3 schedules and have 2 people drive to a destination when let's just try this video conference because we're going to go over the same stuff and we can share it. And God, it didn't take long for folks to realize, yeah, if I don't have to get my ass in a car and battle rush hour traffic as I'm getting out of work, it just changed everything.
well, by the time they got into the office to see you, they were already exhausted and
I
road raging.
could not pay attention if their life depended on it, for sure.
All right, so here we go. We're closing out 22. It has not been an enjoyable year for housing or our peers in the industry. Mass layoffs still happening. Consolidation, mergers, and acquisitions are taking place. Small, medium-sized players are getting gobbled up for the larger people to be able to grab a larger share of the market and increase their footprint. So
stay in existence, right?
Exactly. But you can feel the tide turning right now. Like even in the last week, you can feel it. Yeah, 6.29% isn't still going to stimulate the demand needed to get this thing moving, but we're closer to the end of the rate hikes than we've ever been for the last year. We'll see another 150 or 75 basis points in 11 days. And then we're not sure what's going to happen. There might be 1, 2, 3 more. There might be smaller. But once the bond market sniffs that they might be done hiking, the spread you've been talking about between give everybody an idea of what the spread is between the mortgage rates and the treasury rates and what that means to everybody.
So the 10-year treasury yield is the economic or the bond market, the pricing that is most directly correlated to mortgage rates. So this, if you can see it on my screen, I'll round it up and say the 3.6. Historically, if you take that number and you add 2% to that, that's where mortgage rates typically, I guess, are associated
In
with. Or
that
that's the spread. So in theory, mortgage rates should be in the 5, and we'll call it 5.75 range, where right now we're at 6.25. So that spread that you had talked about, instead of being at 5.6, we're at 6.2 or 6.3. That's widened since we've had the inflationary concerns. And that just means that lenders are skeptical on what's going to happen moving forward. So even if everything stayed exactly the same, that number stayed the same, each month that goes by, mortgage rates should come down closer to that 5.6 or 5.7 level once we've admitted that maybe we're in a state of normalcy. Right now, it's still full-fledged chaos. Nobody knows for sure what this really means.
That's fair.
But more time at this number will indicate normalcy, and then we should see mortgage rates come back down. Now, if this number starts to reduce and the spread, that 2% instead of 2.5 or 2.75 continues, that's where we could get in the low 5s, possibly even crack just below 5 at some point moving forward. Now that's the coin flip, right? It's not 30 days from now. It could be 90, it could be 180, but that's the feel that this number, along with the spread, the addition on top of that, that should continue to ease as we progress through 2023.
Thank you very much. That helps. I'm sure a lot of folks out there wondering, well, you know, why did it get up to 7.3, 7.4%? That was a big part of it, was the fear of the unknown and the fear of we don't know when they're going to stop hiking. So we got to buy some protection. That's what we got to do.
Totally
Awesome
makes
stuff,
sense.
dude. Thank you for sharing all that
Hey,
information.
here's the we'll call it the selfish plug in regards to this of just,
Yep.
that, let me just share it again here real quick. So this history or stuff that we've gone through, as well as now being in our 50s and being able to look back with some, I would call it wisdom, just because we've gone through it. It really helps to share that perspective with the consumer to help them make informed decisions, not selling the Baskin Robbins flavor of the month or trying to direct somebody into doing something that's self-serving. So can't say it enough. There's some stories in there that may help people with their decisions. We didn't make up the stories. We just got to live them. And that's the fun part of the job. Just talk to somebody right before we hopped on this call, got into his house 60 days ago. And, that part of helping people make decisions and having him share how positive of an experience it's been getting into the home, the right area, some budget issues that we had talked through, just couldn't be more excited. That's the rewarding part of the job. All right, I'm done.
Well said. Congrats to 15 years, and let's do 15 more.
Right on.
All right.
See you, bud.
Bro.